Welcome back to Investing Talk Podcast.
Today we're looking at Wells Fargo.
As usual, before we start, subscribe, like, and comment to this video to support the show. Okay, let's unpack this. We have fed our system a towering stack of recent earnings reports, analyst notes, and technical charts centered around this massive traditional bank. And the mission for today's analysis is to answer a really polarized question. Right now, the financial sector is caught in this brutal tug of war.
Oh, absolutely. It's incredibly tense out there right now.
Right. So on one side, you have a legacy institution undergoing what is arguably the most significant structural shift of the decade. The Federal Reserve finally lifting their long-standing asset cap. That represents an unprecedented unleashing of organic growth. But on the other side, there's just palpable panic. The broader sector is terrified of artificial intelligence, wondering if these legacy financial institutions are just dinosaurs waiting for the asteroid.
Yeah, they're terrified.
So we need to figure out for you listening, is this currently a dangerous value trap, or are we looking at a multi-year compounding setup that the market is just completely mispricing?
It's the ultimate tension between historical baggage and future potential. I mean, the market despises uncertainty, and right now, financial stocks are just absolutely swimming in it. But when you look past the daily noise and focus on the underlying numbers we are analyzing today, a very distinct narrative takes shape.
Much more optimistic one, right?
Exactly. We're not talking about some regional bank merely trying to keep its head above water. We're looking at an institution that has literally been operating with one hand tied behind its back by regulators for years. Now that the restraint is gone, the conversation entirely shifts from survival to scale. Like, how quickly can they capture market share in an environment where their primary competitors are essentially maxed out on their balance sheets?
Let's dig into the fundamentals, because that structural shift is exactly where I want to start. The fundamental trajectory here is getting really hard to ignore. We are looking at a third quarter 2025 revenue beat of $21.44 billion. Which is a 5.3% jump year over year.
Which is massive for them.
Right. For a bank of this sheer size, moving the needle 5.3% is significant. But looking ahead to the projections for the first quarter of 2026, which hits next month, by the way, consensus has earnings per share pegged at 1.56 on $21.67 billion in revenue. That EPS figure represents a nearly 23% jump year over year.
23%?
Yeah. For a mature industry, how does a nearly 23% jump in earnings actually materialize?
It comes down to operating leverage. A jump of that magnitude doesn't just happen by accident, you know? It means management is ruthlessly extracting more profit out of every single dollar of revenue that comes through the door.
Right.
When you see their full year 2026 EPS target sitting at a very aggressive $6.92, that is a glaring signal that the underlying engines of the business are finally synchronized. They're managing to pull this off while maintaining a highly fortified balance sheet amid what we all know has been a remarkably complex macro environment. They aren't just growing for the sake of growth, they're growing efficiently.
Let's talk about where that growth is actually originating. Management is guiding for mid-single-digit loan growth in 2026, specifically targeting that 5% mark. Now, that sounds great on an earnings call, but where exactly is that volume supposed to come from in such a competitive lending environment?
That is exactly the right question to ask. And it comes down to two major, highly strategic catalysts. First, they've recently inked major auto lending partnerships with Volkswagen and Audi.
Oh, the point of sale stuff.
Exactly. It's a brilliant move. By embedding themselves directly at the point of sale with major global automakers, they're capturing high-quality loan volume right at the source. It cuts out the friction of third-party financing. It's incredibly efficient origination. And second, they are aggressively rolling out new credit card products tailored specifically for wealth management clients.
Which is a totally different ballgame than subprime consumer lending.
Oh, night and day. Targeting wealth clients is a textbook, high-margin, high-retention play. These individuals generally possess pristine credit quality, and they drive high transaction volumes.
Right, so lots of swipe fees.
Exactly. That combination generates substantial fee income for the bank while keeping default risks at the absolute floor. It shifts the entire risk-reward profile of their consumer lending division upward. They're deploying capital into avenues where the returns are virtually guaranteed to be robust.
So tying that back to valuation, we're looking at fourth quarter 2025 average loans standing at $327.9 billion. A lot of capital deployed. Yet when I look at the valuation metrics, there just seems to be a glaring disconnect. We have a forward PE sitting around 12.2. For context, the industry average is hovering over 13, and their PEG ratio is sitting at 0.92, well below the industry average of 1.1. For you listening, anytime you see a PEG ratio under 1, it generally signals that a stock's price isn't keeping up with its fundamental earnings growth. Why is it trading at such a discount? What is the street missing here?
A market is suffering from a historical hangover. The valuation metrics you just laid out show a clear dislocation between current price and future performance. A forward PE of roughly 12 paired with a PEG under 1 suggests institutional investors are pricing in a level of stagnation that the actual earnings trajectory simply does not support.
They just don't believe the growth is real yet.
Right. But they are generating solid returns. They have plenty of capital to reinvest in these high-return auto and wealth segments, and they're buying back stock. The discount exists because the market is still treating them like the constrained bank they were a year ago, rather than the unconstrained bank they are today.
And that brings us perfectly to the competitive moat. The removal of that Federal Reserve asset cap feels like the definitive turning point. For years, it acted like a financial straitjacket. But now they have this potent combination, remarkably low funding costs, and a vast consumer banking base with exceptionally high switching costs. Think about it. Most people do not change their primary checking account just for a slightly better interest rate.
Oh, it's a logistical nightmare to change banks.
Exactly. That inertia protects their market share against titans like JPMorgan.
The asset cap removal is the crux of the entire thesis. Think of it as the way operating under that Fed constraint was like making an Olympic sprinter run in a weighted vest for 5 years. They couldn't just rely on raw speed or size to win. They had to optimize their internal mechanics. They were forced to get lean and figure out how to be profitable without just swelling their balance sheet.
And now the vest is off.
Exactly. Now the vest is off. They're taking that highly optimized, ruthlessly efficient operational machine and finally hitting the gas pedal. Meanwhile, their competitors are the ones starting to sweat, facing new capital constraints and the sheer law of large numbers. This unique combination of a massive, sticky customer base and newly unlocked lending capacity is a formidable competitive moat.
Pivot to the charts for a second. You make a compelling case for the fundamentals. But if the moat is so impenetrable, why does the chart look like a battlefield lately? They closed recently at $86.76. Yes, that was a solid 2.59% pop for the day, which handily outpaced the S&P 500's fractional gain. But we have to view that short-term momentum in the context of a rather brutal stretch. They took a 4.67% hit over the previous month, lagging the broader financial sector.
That recent one-month decline is exactly where the technical and fundamental narratives collide. When you see a stock lagging its sector despite posting strong revenue and earnings beats, it almost always indicates a localized shock or a specific headline narrative taking hold, rather than a fundamental deterioration of the core business.
It's noise versus signal.
Exactly. The recent price action suggests the market is currently digesting conflicting information, trying to find equilibrium between the long-term compounding story and short-term headline anxiety.
Let's talk about the specific event that drove that anxiety. On February 27th, the stock took a 6.6% nosedive in a single session. This was tied directly to headlines regarding exposure to UK mortgages. For anyone watching the tape that day, it looked like a classic capitulation event. The pain became too much, the algorithmic selling took over, and the price action just got completely flushed out. But historically, a flush out like that often sets the stage for a rebound in fundamentally resilient companies, right?
It does. Capitulation is like a controlled burn in a forest. It is painful and chaotic in the moment, but it clears out the weak hands and creates the conditions for healthy new growth. A nearly 7% drop on an isolated geographic exposure issue has all the hallmarks of an institutional overreaction.
Shoot first, ask questions later.
Always. In the banking sector, the market tends to shoot first when it comes to credit risk. But when the dust settles, the algorithmic selling exhausts itself, and the value investors, the ones looking at that 0.92 PEG ratio, step in. You start to see strong basing patterns form, which is exactly what the technical structures are showing us right now.
You can really see that underlying strength when you zoom out and look at the broader momentum. Yes, there has been isolated volatility. We all saw the recent collapse of Market Financial Solutions, which spooked the entire financial landscape. But despite all that noise, their 90-day gains are sitting at a positive 4.77%, and the one-year total shareholder return is an exceptionally healthy 16.94%. We are seeing higher lows forming on the charts. Order flow appears to be shifting bullish as those negative headlines fade into the rearview mirror.
The resilience of that trend is the key takeaway from the charts. Forming higher lows after a severe capitulation event is a textbook technical indicator that institutional buyers are quietly accumulating shares. They are stepping in to buy the dips, providing a concrete floor for the stock price. It strongly suggests that the smart money is looking right past the short-term noise of the UK mortgage headlines and focusing directly on the 2026 earnings trajectory and the structural advantages of the lifted asset cap.
Shifting to sentiment and market perception, the mood out there is completely fractured. On the bullish side of the ledger, you have commentators like Jim Cramer openly praising their artificial intelligence integration efforts. And this isn't just fluffy public relations. They have been strategically poaching top executive talent from Amazon Web Services. But what does that actually mean for a legacy bank?
It means everything. Traditional banks carry staggering amounts of technical debt. They're often running on outdated, siloed mainframe systems that are expensive to maintain and slow to adapt. By bringing in leadership from a cloud-native juggernaut like AWS, they are signaling a very serious, well-funded commitment to leapfrogging the competition. They are rebuilding their architecture to be cloud-first.
And in banking, efficiency is everything.
It directly translates to operating leverage. If they can successfully implement advanced AI models across data processing, automated customer service, and real-time risk modeling, the impact on their bottom-line margins will be profound.
But there is a glaring contrast to that bullish tech narrative. We are also seeing a lot of neutral to bearish noise regarding regulatory scrutiny over fraud reversals. Plus, there is an overarching sector-wide anxiety hitting financial stocks. A significant portion of the market is terrified that AI is going to disrupt traditional banking entirely, making these legacy institutions obsolete.
It's a fascinating market paradox. You have the broader financial sector selling off on the fear that AI will disrupt legacy banks, while simultaneously this specific bank is aggressively hiring top-tier AI talent to ensure they're the ones doing the disrupting.
Right, they're on offense.
Exactly. Now, regarding the regulatory scrutiny over fraud reversals, it is certainly a persistent headache that requires monitoring. Compliance costs can eat into margins. However, you have to weigh that regulatory friction against the tangible, massive steps they are taking to modernize their operational efficiency. Right now, the market is heavily weighting the fears and heavily discounting the proactive strategies.
Let's lay out the catalyst calendar for you listening so you know exactly what events could force the market to reprice this stock over the next 3 months. The main event is the Q1 2026 earnings call, scheduled for April 14th. As we mentioned, consensus is looking for that massive 23% EPS jump to $1.56. We also have potential strategic updates coming from various UBS financial conferences. And zooming out to the macro environment, the entire street is watching rate cut expectations. Right now, the Zacks rank is sitting at a stable number 3, which means hold.
That Zacks rank of hold perfectly encapsulates the current institutional psychology. Analysts are waiting for definitive proof. They see the $6.92 full-year projection. They know the asset cap is lifted, but they want to see the execution in that April 14th earnings report before they are willing to upgrade their ratings.
And what about the rate cuts?
Well, regarding the macro environment, rate cuts are typically a double-edged sword for bank margins. But in this specific case, lower borrowing costs could supercharge that point-of-sale auto lending and credit card volume they're heavily targeting. It perfectly aligns with their newly unconstrained expansion plans.
Let's flip the coin and look at the bear case. I want to thoroughly pressure test this thesis because a PEG ratio under 1 doesn't happen in a vacuum. There's real fear priced into the stock. Risk number 1 is the elephant in the room: credit and operational vulnerabilities. We just talked about the UK mortgage exposure that triggered a 6.6% sell-off in a single day. Are we entirely sure this is an isolated event? A drop that sharp smells like the market pricing in a contagion risk, not just a localized hurdle?
It's a vital debate. When you are managing a multi-trillion-dollar lending portfolio, you are mathematically guaranteed to encounter localized pockets of stress. The UK mortgage market has unique dynamics right now, specifically around how floating rates are resetting and pressuring homeowners. That is a real risk. However, you have to look at the proportionality.
It's a drop in the bucket for them.
Exactly. It represents a fraction of their overall loan book. The critical metric isn't whether bad loans exist, but whether the bank has adequately provisioned for those credit losses without eating into their core capital. Their recent earnings beats and robust balance sheet metrics indicate that they have the reserves to absorb these isolated shocks without derailing their 2026 growth trajectory. The market priced it like a systemic failure, but the math suggests it is a manageable expense.
Fair enough, but what about the operational side? The fraud reversal scrutiny isn't just a one-day headline. Regulators don't just hand out fines and walk away. They often force behavioral and procedural changes that permanently increase compliance costs and compress margins.
You are absolutely right. Regulatory friction is the permanent tax on legacy banking. Increased compliance means hiring more risk officers and slowing down product rollouts. But this brings us back to the AWS AI integration. By automating vast swaths of their compliance and fraud detection architecture with machine learning, they can offset those increased regulatory costs. The efficiency gains from the tech side act as a shock absorber for the regulatory burdens.
Let's hit the existential threat then: AI disruption. The bear thesis is that nimble fintech startups with zero legacy tech debt are going to eat their lunch. How does a legacy bank actually compete with a startup that can use advanced AI to underwrite loans in seconds without the overhead of thousands of physical branches? Doesn't the recent market sell-off based on AI fears hold some water?
This brings us to one of the most important debates in modern finance, the battle between distribution and innovation. Yes, a fintech startup might build a brilliant, lightning-fast AI underwriting algorithm, but they have a massive problem: customer acquisition costs. They have to spend a fortune on marketing to convince you to move your money to their platform.
Whereas a legacy bank already has the accounts.
They already own the distribution. They have tens of millions of sticky, active accounts. Furthermore, AI models are only as good as the data they are trained on. Startups have to buy data. Legacy banks are sitting on oceans of proprietary, decades-long transactional data. If a legacy institution successfully integrates AI, which is exactly what those AWS hires are tasked with doing, they win, period. Their newfound freedom from the asset cap gives them the financial armor to invest heavily in this transition, entirely insulating them from the disruptions that might wipe out smaller, undercapitalized fintechs.
Let's bring it all together for the final verdict. Weighing that massive proprietary data advantage against the regulatory and credit risks we just outlined, where does that leave our quantitative analysis? When we run the fundamental projections, the technical basing structures, the sentiment analysis, and the risk factors, we arrive at a bullish score of 8 out of 10.
An 8 out of 10 is a signal of strong conviction. It reflects a very compelling asymmetry between the known, priced-in risks and the unpriced potential rewards. The broader market is currently pricing this stock based on its constrained, heavily regulated past, while the underlying fundamentals are rapidly aligning with a highly efficient, unconstrained future.
Here is the elevator pitch for you listening. We are looking at a core multi-year investment thesis. You have a bank projecting mid-single-digit loan growth for 2026, driven by highly strategic auto and wealth credit card expansions. You have an organization totally liberated from a suffocating Fed asset cap, allowing them to finally go on the offensive. And you have aggressive AI efficiency initiatives designed to drive operating costs down. All of this strongly positions their earnings per share to hit that $6.92 target. The recent volatility surrounding UK mortgages isn't a red flag. It is a prime entry point to get in below intrinsic value.
Precisely. The target horizon here is not a quick day trade. This is a strategic multi-year hold stretching deep into the 2026 earnings cycle. You have to give the thesis time to play out. As those quarterly earnings reports sequentially validate the loan growth and operational leverage, it will force the broader market to abandon its historical bias and reevaluate its pricing models.
Which leaves us with a fascinating final thought for you to ponder. We spend so much time looking for the next Silicon Valley darling. But could the legacy banks that actually successfully integrate cloud architecture and AI like this one is attempting to do right now ultimately become the new tech growth stocks of the next decade? Could their proprietary data moats completely redefine how the entire financial sector is valued? Think about that as you look at your own portfolio. As always, make sure to subscribe, like, and comment to support the show. We will see you next time.